How do you compare a 4-unit apartment building in Texas to a duplex in Florida? You use the cap rate. Think of the cap rate as a quick health check for an investment. It tells you your expected percentage return if you bought the property entirely with cash. Today, we are breaking down how to use this metric to instantly tell a great deal from a terrible one without getting bogged down in complex math. In commercial properties, the capitalization rate is a useful measurement for risk assessment. It's a metric that shows a property's expected annual rate of return based on the income it generates, assuming the property is bought entirely with cash. Okay, here's something to remember about the cap rate. The higher the cap rate, the higher the risk and the lower the market value of the asset. And conversely, the lower the cap rate, the lower the risk and the higher the market value of the asset. See, it's easy to remember that the higher the cap rate, the lower the value, but also remember that the higher the rate, the higher the risk, the lower the rate, the lower the risk, and the value is the exact opposite. Okay, so keep that in mind. All right, let's do an example. Imagine a rental property with the following numbers. Purchase price, $1 million. Annual rental income, $80,000. Annual operating expenses, $20,000. And operating expenses, in this case, includes property taxes, insurance, and maintenance. All right? So that means that we're going to find the net operating income by subtracting the operating expenses from the rental income. Plugging the numbers in, that's 80,000 minus 20,000, which is the operating expenses, and that will give you the net operating income of 60,000. Now, step 2 on that, because all of that was to get the NOI. And now that you have the NOI, you're going to divide that by the purchase price. So with a $60,000 NOI, that's going to be divided by 1 million, which is your purchase price. And that's going to give you 0.06. And you're going to multiply that by 100 because you need this to be a percentage, and that's the way you're going to get your percentage, multiplying it by 100. So your question at this point should be, is 6% good? Yes, 6% is a good percentage. And risk versus reward. These are this is the ranges for cap rate. This is low risk, lower return. And as we said earlier, the lower the cap rate, the lower the return, the higher the asset value. So this is low risk, low return, premium, class A location. The cap rate range here is 3 to 5%. Highly stable tenants. It's a newer building, low repairs. So low cap rate, lower risk. But you will get paid. Okay? It's a newer building, low repairs. So you're going to be paid. It's a premium class A location. You will get paid. And you're going to get paid nicely. Okay. So the second range, 5 to 8% cap rate. This is a balanced range. Solid suburban area, average market growth, Moderate maintenance cost. So this is where that 6 came out. This is where you want to try to be, unless you're going to get in the 3 to 5%. And the next one is 8 to 12% cap rate. High risk, higher return. I don't know. Okay. High risk, higher return. Declining neighborhood, you're charging more, but the risk, there's going to be a lot of, here we go, high tenant turnover, older buildings needing repairs. So yeah, you're charging more, but you're going to be spending more also. So, that's it, you decide where you want to be. But, and if you're wondering where these uh, ranges came from, this is J.P. Morgan. I use them as a reference for cap rates. And if you're someone that is into formulas, you might find this interesting. To find cap rate, divide income by value. So that's I over V equals R. To find property value, divide income by the market's average cap rate. I divided by R equals V for value. And to find expected income, multiply the value by the cap rate. So that's V times R equals I. And this is known as the IRV Formula Triangle. Just a little something to play with, okay? And that is all we have today for cap rate. And actually, that was just touching, and that was just, the surface. There's a lot more there. So, but I want you, again, remember, every successful investor started by learning the language of real estate, master the terminology, understand the numbers, and the deals become much easier to evaluate. So, till the next video, take care